Okay, good evening, Sanbanan, and welcome to webinar number 2. For those of you that don't know me, my name is Zain Khan, and I'm going to be co-facilitating this webinar. And today's webinar obviously is on saving and investing. For those of you that have just joined us, welcome. Thank you very much for being here. And as I said, my name is Zain, and I'm going to be the one that's co-facilitating basically the session. Now, before we proceed, I'd like to open up with a prayer. If I can ask all mums who are here to open up with a prayer for us.
Lord Jesus, Son of David, bless our CPI, Indlovukazi KwaZulu. We call upon you, Lord, to be in our midst in this meeting, training. Bless our leaders, bless Delhi and the board and all the members. Bless our trainers. Open our minds, Lord. Enable us to accept and to internalize the training so that we are able to do the right things that we need to do. Guide us in this journey of developing this bank to its maturity. We ask you in the name of the Lord Jesus Christ, our Lord. Amen.
Amen. Thank you very much, Mam Square. Now, ladies, if I recall last week, we went through, or we discussed the series of these webinars. As you know, today we are doing saving and investment. Just a reminder, on the 23rd of November, we are doing business management. And obviously on the 30th of November, we're doing credit and debt management. Now, I know that you will all be there for both the following webinars. Now, before we proceed, I'd like to just explain how today's webinar is going to go. If you recall, last week we had certain questions that were raised that we didn't exactly answer, and obviously we parked them to be able to pose those questions to our expert, Thembisa Luthuli, who's part of the webinar today. So, but for those of you that have got questions, please, ladies, do not hesitate to ask us your questions. I would like you to put your questions on the Q&A, and when we get to the end of this webinar, I will then address those questions to, or I will pose those questions to Thembisa on your behalf. So ladies, if you recall last week, we had several questions that we parked, and I did indicate at that point in time that we would pose those questions to our expert. So before we carry on any further, I'd like to firstly welcome Thembisa Luthuli, who is our certified financial planner. Thembisa, welcome. I'm glad you are here and you're part of this webinar. So welcome and thank you very much for being here. Thembisa is a certified financial planner. She's a lecturer at UKZN. And I have to be honest with you and say that I've had the opportunity of listening to some of the interviews that Thembisa conducted on Gagasi FM last year. And I have to say that, yeah, I was most impressed. And I too personally learned a hell of a lot from her. So Thembisa, well done, and thank you very much for being here. But Thembisa, just to put you in the picture, last week we had some questions that were raised that we actually parked, or we chose to park, and I'd like to pose those questions to you, and obviously get your input so that our participants have their questions answered. So last week's session was all surrounded planning with money, and of course we did needs and wants, and we did budgeting, and we did communicating with money. So the first question that arose was, when budgeting, how does one split the budget to ensure financial resilience? Example, do you do a 50-20-30 split, or do you do a 70-20-10? What would you recommend for our participants, or what would you recommend for anyone for that matter?
Thank you for having me, Zain. I'm so excited, and especially that I'm speaking to women. I'm such a fan of women trying to financially build themselves. So as you have mentioned that you guys talked about a lot of topic, including relationship with money and communicating about money. I'm sure you would have touched, or if you didn't, there is one thing about money that is important that we need to understand is that money and money conversation are not one size fits all. So in answering your question, that should be on top of mind, that whatever works for another person might not work for another. That's because we have got different needs, we've got different wants, we've also got different responsibilities. So as much as we have the 70-20 10 budgeting tool that can guide us, it can suitably work for other people, but it can also do not work, because what does this budgeting tool says to us? It says your 70% of your income should be going to your monthly bills. So your everyday spending that you have, paying your bond, paying your car, 70% of your income should actually be taken care of on that 70%, and 20% should be going to savings and investment. And then you can use 10% for donations or any debt repayment. Now, this will work for somebody who has debt, but also which needs only 10% of their income. But it might not work for somebody who needs a bigger portion of their income to actually go to debt payment. So it's much of a flexibility. You always need to have a look at how am I spending, what do I spend on, then see if this budgeting tool can help you. While on the other hand, the 50-30-20 says to us, 50% of your income should be going to your fixed expenses or your needs expenses. Your needs is such as your transport, food, a roof over your head, things that you cannot survive on without, or things that your life will really be difficult if you do not spend on them. So 50% of your income should always be spent on those things. And then 30% can be spent on lifestyle management, what we call wants. So these are the things like your holidays, you could be spending on any lifestyle management. And we can then say debt is part of lifestyle management, because sometimes we take credit cards and overdrafts just to manage our lifestyles, and it should be falling onto this 30%. Then obviously the 20% still stands on, it should be going to your savings and investments. And that could mean different things for different people. So I always say, the tools are very fluid, meaning they're very flexible for each of us, but the best tool you could use is sitting down with your money first, talk to your money, and maybe find professional help. Then you'll find the most suitable one for you. I'm not too sure if that was clear enough.
Absolutely. So simply put, what you're saying, it's dependent on our personal circumstances.
Definitely, Zane. It depends on your personal circumstances. Yes.
Okay, great. Thank you. So the next one was savings versus paying debt. So the question here was, with the current lending rates being low, how does one prioritize? Do you pay off your debt first, or do you still save and use some of the money to pay debt? Just explain to us, where do we go? How do we do this? What do we do in this situation?
All right. Let's remember that both the sides of the coin have what we call interest. So on the savings, we are hoping to receive the interest, but on the debt, we are paying the interest. So it's always a war between how much interest are you paying versus how much interest are you getting on the savings that you have made. So the question, if the question is either as should I save or should I pay debt, the simple question will be, keep the balance. First, save for emergencies so that you cannot go to the same debt that you're trying to finish off. obviously there are rule of thumbs of how much emergency money should I have. Depending on how much or how big the debt is, it might be impossible or unreasonable to try and save 6 months worth of salary while you've got so much debt piling up, so much interest. So the recommendation is always save a little bit of a buffer that will protect you if any emergency is coming in, like the small emergencies. If you've got a tire punch, somebody dies at home and you need to contribute, or a geyser burst, have at least that 10,000. Then you focus mainly on paying the debt, because in most of the cases, we find ourselves paying very much high interest on debt. So it is an opportunity to then go back and relook on the interest rates that you pay on the debts versus the interest that you receive. And in this current interest rates environment, we know that the lower interest rates are not in favor for savings, because that means you're getting very low savings returns if your money is just sitting in the bank. But it's a good opportunity to save on a bigger interest that you would have paid. So if you can quickly pay off the debt while the interest is very low, you'll be saving a lot in the future. But ensuring while you're focusing on that, you do not compromise your situation or yourself in such a way that when any emergency, because you can't avoid that. If any emergencies come in your life, you can be able to without going or extending the debt that you are already trying to pay off.
Okay, wow, wonderful. Thank you very much for putting that into perspective. So, Tembisa, the next question is, we were talking about communicating about money, and I think we all know that it's a very sensitive issue, and we tend to want to keep it confidential, and many households or many individuals choose not to discuss their budgets with their loved ones. So my question to you here is, or the question was raised last week, was that women are encouraged to keep some savings a secret or keep it hidden from their partners. My question to you is, or I think the participant would like to know, is it advisable that we keep a certain amount or a certain percentage of savings hidden from our families and our loved ones? Now, I know it's a sensitive issue, and I know that we don't like talking about it. What would you advise us?
This is such a sensitive issue, and I find it a lot under my financial coaching session. I'm a professional financial coach, and I do sometimes do financial counseling between couples. And I always say, again, there is no one size. It also depends on the circumstances of the relationship that you're in. It also depends on the type of marriage that you're in, because no matter how you hide your money, but if you married in community of property, it will catch up with you somehow, somewhere in the future. So for me, communicating about money is a key element that needs to be there in a relationship, and being honest. And being honest means you don't put yourself in a vulnerable situation where you expose too much about your finances. Everyone is allowed, although you're in a relationship, but everyone is allowed to have sort of confidentiality, just as we keep our independence as much as we are partners. But with your partner, there needs to be an understanding that we have things that we do together, but you also need to have things that are of your own and they are on your name, and you protect that with all you have, because we love and trust our partners, but we can never be sure of what will happen in the future. As a protection, yes, you can have money that is staked, but keeping it as a secret, it also depends on the circumstances of the relationship and how you structure that investment. It will depend on the circumstances of your relationship and the type of marriage that you have. But it's definitely a good idea that whatever you do, you could be doing it with your partner, but have some sort of a safety net to protect yourself. This comes from the experience of other people that we've seen suffering after marriage or suffering if the husband died. And then there's nothing to even start with while you're waiting for the estate to be wound up because you have no savings. So it's definitely a matter of have something on your own. But on the point of should you keep it a secret, it then depends on the circumstances. For me, I do have those savings, and my husband knows. He just doesn't know how much is it or where is it, but he knows that I save beside anything that we do together, but I save for myself, for my safety net and my go-to savings. So I'm not too sure if I am being ambiguous or being controversial, but this is such a deep question and it always needs a view of each individual. But just in a general, yes, keep a safety net, but communicate about it if the situation allows, but not too much information if the situation doesn't allow as well.
So, and to show you, Guti, yes, you can say Guti nginaso imali, but I'm not going to tell you Guti nginamalini. Is that what you were saying?
Yeah, he doesn't need to. I mean, we both individuals who decided to work together in a relationship and raise children. We feel each other, but at the end of the day, we're still individuals within our marriage, which we love. If we've got clear communication and understanding, it shouldn't be an issue. He's also allowed to do that because men do that. They do have their own savings. So why shouldn't I have such?
Okay, great. Thank you so much for putting that into perspective. So, you know, there's another question, and you know, this question came around from the topic that we spoke about, which differentiating between or business money versus personal money. So if you were in a situation where you were working from home and you're paying yourself as a homeowner, you're paying rent, what are the tax implications on that? So if I'm working from home and you know my business pays me rental, what are the tax implications there?
Okay, let's clarify that because tax can be very complicated and it can be very tricky. It's a good thing that you asked that question because I am in that situation. I work from home 100%. But it's not a matter of the business paying rent. What is allowed according to the tax rules and act that you can claim home office expenses, that's what we call it, as a business or as an individual against your income. So what it means is you submit to SARS that I work from home 100%. I pay 12,000 per year for electricity. I pay 12,000 per year for water. I pay so much of the bond. This is the interest I pay on my bond. They want an interest, not the capital amount. This is the interest I pay, maybe 100,000 as an interest on my bond. I pay 24,000 on the rates. And the portion of my office in this 600 square meter house is, let's say 20 meters square, then SARS will say out of that you qualify then to claim or to deduct, that what we call it, to deduct 25% of those expenses against your income, meaning it shouldn't be taxed. So they will then calculate and then they will rebate that to refund that to you. So it's called home office expense. If you rent in the space where you are working and you do not pay a bond, probably you rent a flat and you use one of the rooms as a home office, you can still claim that I rent so much per year, I pay so much rates and water and electricity, and this is the portion of the house that I use for generating this income. Then they will deduct against that income. That means your tax get reduced by that amount that is qualifying. So you can't charge rent on yourself, if that makes sense.
Okay, perfect. That's wonderful. Thank you very much for that and for putting that into perspective. So lastly, Tembisa, You know, with load shedding, you know, it has really affected every single one of us. And the question, this last question that came up was, you know, are there any rebates that are linked to load shedding? For example, you know, some of us have to travel a lot longer to meetings. Can one claim for extra travel, considering that you're spending a lot more time now driving to a meeting because of load shedding?
The simple answer will be no. There's nothing linked to load shedding that you can claim against in South Africa, even if you lose your appliances. Claim on some municipalities, it's just stressful like that. But in terms of traveling claim, remember, if you are a business person and travel for the purpose of business, again, on your tax returns, when you're doing your tax returns and submitting that I've made this so much income from my business, but these are the expenses that I've incurred in order to generate this income. And part of those expenses can be the kilometers traveled with your car. So you need to have the details of the car that you to make travels, submit to SARS that out of the 100 kilometers, 100,000 kilometers that we submitted, that were done by my car over the year, 60,000 of that were used for business. And this is how much petrol I spent. This is how much I spent on fixing the car. And then that can be used as a deduction again. And then it's reduce your tax as well. So you cannot claim because of load shedding if the travel has been long, but you can claim business travelings against your rate.
Okay, it seems to be distorted. The line seems to be cutting. I'm sure everyone else is experiencing the same thing. But Thembisa, thank you so much for clarifying all of that and for answering all of those questions. I have no doubt that all our participants have now absolute clarity on everything that they raised, and or the questions, or they have the answers to all those questions, those wonderful questions that they had. So ladies, without taking too much time, I'm now going to hand you over once again to Thembisa, who's going to take you through saving and investment, that obviously being the theme of the day, or for this webinar. And so Thembisa, it's up to you. The floor is yours. Thank you very much.
Thank you so much, Zane. I hope now my network will be smooth. I was trying to change the connection because it seems the other one that I was connected in is a bit distorted. I'm going to be taking you guys through savings and investing. And maybe as an introduction, and maybe as just a debrief on what is savings, because in most of the time we get a confusion or a misunderstanding of what is the difference between savings and investing, and what should I do, which one should I do, which one I shouldn't be doing. First, saving is about delaying the immediate spending. So you want a coffee machine, you want that fridge, but you do not have the money to buy it now, like a 6,000 rand now. But you can see that if you were to save at least 1,000, you can get that in the next 6 months. So saving is all about delaying the immediate spending until you can accumulate enough money to spend on that thing. So it's usually more of a short-term exercise that you do so that you can afford that specific goal. You can afford that specific item that you want. And why savings is important? Because savings save us from going into debt. So if you can learn a discipline of delaying those immediate spending, then you are able to save yourself from swiping that credit card, then pay an interest of 25% for a machine that you could have bought with 7,000, just waiting for 6 months. Then you pay for 3 months, for 3 years for the same machine. You end up paying 3 times the amount when you're really calculating the impact of the date. So you usually set the money aside so that you can pay for that thing in the near future. Underlying the word near future because it's usually for short periods. Short periods, we know them as 0 months up to 12 months or even 24 months if the goal is a bit bigger than just to save it for 6 months. While on the other side, investing is, so saving is more about preserving the capital that you have so that you can buy something soon. So the important thing about the saving is that the capital that you have or you are trying to accumulate is preserved, meaning it's important that it keep its value. So if you've saved 7,000, you need to get it as 7,000 or at least with some sort of interest. It shouldn't be affected by the market fluctuation. You shouldn't find it after 6 months being 6,500 because the goal is near and you need to find the capital as is. So savings is more for capital preservation, while investing is now saying to your money, okay, you want your money to grow and give you some fruits. So it's more of a longer term thing or longer term periods, because when you save, it's like you buying your oranges today, which is a Tuesday, hoping to use them in Saturday. But when you're now investing, you buy an orange tree, hoping to have in the long term the oranges in your yard. Every time you need an orange, you just pick it up in your yard because you have planted a tree that will generate these oranges. So that's why investing is about making sure that it's capital growth rather than capital preservation. So investment should be made for longer periods, and we term longer periods such as 5 years or more. But you could also make some medium-term investments such as 3 to 5 years, when you've got a goal that you know, okay, I've got a child now that needs to go to the university and they're now 5 years away from going to the university. Then you can do an investment that is sort of like more of capital growth, but there is some portion of that capital that will also be preserved because you need this money in a medium period. You should have your savings for your short-term goals. That's why it's important that you're able to identify your goals first, but also when you've identified, be having a clear picture of, is this a short-term, medium, or long-term goal, so that you can be able to put your money in the correct basket. Because if you're gonna put your money in the basket of savings, but you've got a longer term, such as you cannot save for 5 years. You cannot say I'm saving for 5 years. You should be in a space or in a basket of doing investing, because that money could be doing a lot of work because of the 8th wonder of the word that we have, which is called compounding interest. What that actually means is that your money is growing on top of each other. Whatever interest that you get on the investment usually also generates its own interest, and that is more than what you would get on the saving space, because on the saving space it's either you get just what is inflation, sometimes less than inflation because it's determined by the interest rates only. But on the investing side, you get to get growth. I will explain more on what type of growth you can get on the investing side. Okay. So the question is always, should I save or should I invest? The reality is we always need both. And I always say, if you haven't got to the habit of saving, you will definitely not pass on the world of investing, because saving is the enabler of investing. Once you are able to master the process or the discipline or the habit of saving, you are used to this thing of putting money or having money that is going away from you to spend. Now, when the time for investing has come, you already got into that behavior and discipline. You just need to wait for a little bit longer so that this money generates a bigger amount of growth than you would have got to the savings. So should you save or invest, you need to do both, because remember, we all have short-term goals. We always have short-term, medium or long-term goals. There's always something to be done in a short-term period. There's always something to be done in a medium-term period, and there is always something that you wish to achieve in a long-term period. So where should you save most, or what are the savings tools that we have currently in South Africa and in the industry, and that you can use, so that you will also not confuse the tools that are there for investment and you use them for savings, and use tools that should be used for savings and think that you should use them for investing. So things like a bank savings account, things like some of the stocks fields, some of the market money funds, some of the cooperative financial institutions are all good for short-term goals. Like, I am saving to buy a fridge at the end of the year. I am saving to make sure that I pay the school fees the following year. But I also need to have an emergency fund. Remember, the tool that you use for savings, you should ensure at least two main things. One, it should allow you flexibility. So it means when you need the money, you can get it within a few days. For example, at least 7 days. Some savings account lock your money to 30 days, but depending on the goal. For example, if the money is for emergency, you cannot put an emergency money in 30-day fixed deposits, because an emergency is something that needs money now and needs to be accessed now without penalties. But if it's a saving for, you're going to need the money in 6 months, maybe you are just collecting money for a stokvel, then you can fix the money for about 6 to 12 months, all right? So it is important that you identify the goal so that it will be easier to identify the product that fits exactly to that goal. Medium-term goals include, you save for your car, you want to save for a deposit for a house, or you want to save for maybe an education for a child, but the child is closer to go there. Then you can use certain products that we have in the industry, such as your unit trust funds. Again, you might need a professional to actually choose the right unit trust that is suitable for medium term, because some of the unit trusts can be aggressive and only suitable for long-term goals. So it is important that, again, I will repeat this over and over again, because we make a mistake of just saving without goals, and you end up keep on using your savings and starting afresh because you did not have a goal on what you are saving for. So there is no driving force behind of where do I want to go, what do I want to achieve there, and when do I want to achieve that. So 3 things about your goal. You need to understand what is it for, when do you want to achieve it, and how it needs to be measurable and how much it should be. Then it's become easy for a professional, or even yourself, you can do it yourself, to identify a good fitting product of, this is where you need to save if you need to save, but this is where you need to invest if you need to invest. So understanding the goal first will make it easier for you to understand if it's a short, medium, or long term. So for long term, you are now investing for things like retirement, tertiary education if you still have young children, starting a business. Those are all the things that you need to put in for long-term investing. And that's where the opportunity lies, because if I'm still 31, I'm probably 25 years before retirement. And the wonder of compound interest means I can actually triple or even 10 times my money if I invest early as now, because compound interest will make sure that whatever growth I get this year will also get its growth next year. The following year, it's the same thing. So the compounding impact has a bigger role that it plays on investment. Because of what? Because of time. Time plays a bigger role when we are investing. Now, we do understand that when we are saving, we're not buying anything. Most of the time, we give our stokvel members or the money, we're just accumulating money to get that capital and preserve it. We're going to take it out as well at the end of the year or whatever period. We're not buying anything. We're just preserving the money. We're expecting whatever interest that we're getting, and it's going to grow in that rate. But with investing, as I've said, it's all about growth. And for you to realize growth, there needs to be something that has been planted or something that has been growing or has been bought. So investing is about buying financial assets and putting financial instruments for a certain period of time in order to make more money and grow wealth. So there are a lot of investments that you can do. Some they are proper. We also have scams that you need to be aware of. But with investing, it's not complex at all. It's all about identifying what type of assets am I willing to invest in? Am I willing to put my money on and for a certain period of time? Then you understand that asset and then you stick with it. The good thing is that you can actually mix those assets. We know of assets like property. We know of assets like shares, sometimes called equity. We know that there's something called bonds. We know cash is actually an asset because cash grows in value. We know things like treasury bills. So those are all types of investments or in financial instruments that can be mixed together for novice, sometimes investors, for those who doesn't want to get involved in trading shares, buying them every day and selling them every day. That's what investing could be for other people. But for other people is to buy a share and then hold onto it. For you to make sure that you are making money in investing, you need to ensure that whatever you're investing on will grow in value so that it will give you more than what you've put in. You need to understand if it will give you a profit or it will give you dividends or it will give you interest or it will give you a combination. Because you get an investment that gives you a combination of all, where they declare dividends in your investments and then it grows in that way. But also the other part is that your investment grows in value because you've bought an asset that you buy it today with 100,000. Because it has value in the market. Value means there are people who need it and want to own it. So in the future, you've got an opportunity to resell it back to the market at the higher value, probably with 200,000. Then you make a profit from that sale. But the thing that makes most people fail in investing that we do not have is patience. Investing needs you to be willing to leave your money invested for a period of time so that it can grow. We lack patience to wait for our money to work for us. We always want quick returns, which then make people fall into scams. I'll get into that. So it is very important that you have it in your mindset that if you're getting into the investment space, you actually need to have patience and it's for long term. So time factor is one of the critical things. You need to give it time, 5 years or more. Business can be a good investment as well, because I know people will say, but what if I start a business and invest in it? It can be a good investment because if you invest in a business and the value of the business grow in the future and you decide to sell it, it definitely can be a good investment. So as I've mentioned, in some of the investments, such as your unit trust, where they've made it nicely for an investor who doesn't want anything complicated, they will mix the assets for you, such as shares, property, bonds, and cash. And most people have always thought that for you to invest in property, you need to own a block of flats. You need to own the physical structure of a house. But with technology now, we're able to invest in property with a portion of your money, even with a 500 Rand or 1,000 through unit trusts that have been offered to us. Because all those contributions that we make as a collective is taken and then to be invested in the actual property without you having to stress with managing the property or the block of flats, whatever the property that you might have interested in. So there are a lot of opportunities that are there in the investment space. Okay. Just to maybe dig deeper into the instrument that I have mentioned. What are they? How do they grow? How are they taxed? I'm just going to touch a bit on the tax implications, and if you have such an investment, what does it mean for you while you're alive? But we cannot ignore the fact that at some point we leave all this wealth that we're trying to build. What will happen for the next person that you leave these shares with? How can you live with them so that you can create generational wealth? Because I believe that we just don't create wealth for our own self only, but we're trying to create wealth for those who will live behind as well, for our families to have better future. So I will touch how can you put this in your will and what impact that will have, and what are the tax implication of owning such assets. So first one is shares. They are also called equity of stocks. You buy shares so that you can own a portion of a company. So it could be a small company, it could be a bigger companies that you know, but shares are issued. Most companies issue shares so that they can grow they can get money to grow their business. So a small business could be starting really a lucrative future business, and they say, well, this is my company for now. It's only valued at R1 million, but I know in the next 5-10 years, it will be valued at more than 10 million. Those who trust in the idea and those who trust in that company, they will then say, for us to give you our money, we need to secure that we have vested interest in this. So I will give you, if you're looking for 5 million to grow your business, give us a share portion of your business. So they'll say, okay, issue us some shares that we can buy. And then shares will then be issued. That means you own a portion of that company. A percentage is determined by the value of the share and how many shares you have bought. We know of many companies that we use every day. From the bank that you use, from the Colgate that you use at home, from the car that you drive, from the cell phone that you have. All those companies are companies that are in the business of making money, and they issue shares every day through the Johannesburg Stock Exchange, where they really want to grow their businesses. And every now and again, they offer these shares to investors to say, for us to become bigger and bigger and bigger and bigger for the generations to come, own a portion of us, and as we grow with you. So buying a share on an equity of a company means if you are buying 3 shares and the share is worth at that time, say 2 Rand, 5 years later, the share has grown to 10 Rand. That means over 5 years, you would have made an extra 10 Rand, an extra 8 Rand on the growth of the share. But as an incentive, in most of the time, these companies issue what we call dividends, and dividends come from the profits that they make. I will make an example with one of the banks that started, I think 16 years ago, Capitec. When Capitec came, was a small bank against bigger bank, where their share, I think it was about 3 rand at the time. And now the Capitec share goes between 1,600 to 1,800. So those people who trusted the value proposition of Capitec at that point and saw it as a potential bigger player in the banking industry, and then they said, okay, fine, your share is 3 rand, I'm just gonna buy 10,000 worth of shares. Their money have like gain 100-folds today, because now the 3 rand is now, where if they haven't sold their shares, the 3 rand is now over 1,800 per share. So that's how your money grow. But the other portion is that as capital grow, people buying their services, they make some profits, which profit come from the fact that the company has expenses, but whatever is left after paying all the expenses that they have, taxes and all, they then share that profit with their investors, and it's called dividends. So this is the second way you make money in the same type of investment. So as much as the growth is there, you then get dividend declared to your investment, and that grows your investment as well. But you obviously get tax if you sell your shares and you've made profits. It's called capital gains tax, and that is part of your income tax. So that's why I always say, if you've own a share portfolio, be aware of now selling your shares now and again because you've sown profits, because you trigger what we call capital gains tax. Tax can be a topic on its own, but that's the type of tax you get to incur if you have bought shares. Now, with share ownership, in most of the case, we can't write beneficiaries on the products that we have. So it is always recommended that you get a will, write who should the shares be given to if you die. So shares, if you own shares and you're thinking of buying shares, knows that, so that it will not complicate your estate. Write on your will, I've got so much shares with such a broker, if you're using a broker, and so should receive my shares. So you can then do that. All right. Bonds, that's the other type of financial instrument that you can invest in. And bonds are usually a financial tool that is used by institutions, I will say, such as public institutions, some private institutions. So government will say, we want to improve our economy, we want to improve our social status, but we need money from the community. Besides, we already take, but for us to get, as the government, for us to get more money from the community, we sort of like need to borrow it. So they issue what we call bonds, and bonds are usually timed. So in an essence, you are now borrowing that institution your money. In return, they will give you yields, yields or interest in a simple term, but bonds generate yields, and those yields are given in a fixed interest rate, or a rate that is fixed for a certain period of time. So if a government will issue bonds for 5 years, they will tell you, okay, borrow us your 10,000, but in the next 5 years, you will not get your 10,000 because we will be using it. But our promise to you is that when we give you back this 10,000 after 5 years, it would have generated at least 8% interest, or it generated 8% yield every year. So depending on what they are offering you, that's how bonds works. They are more safer than shares, because shares fluctuate. according to what the market sentiments are and what is going on the market. So the value of the shares today is something else, the value next week is something else. So it does fluctuate, and that's the risky part of it. Hence, you need some time so that the correction can happen of the up and downs. But then with the bonds, you know that you've been promised a fixed yield. But obviously, because there's that fixed component, you probably won't get as much profit or as much growth as you would have got on the shares, but at least there's some sort of protection for the capital, because you know exactly that you will get your 10,000 at the end of the term. So this is when you as an investor, you will buy those bonds that have been declared by the organization, and they promise to repay that loan with interest to you. So again, bonds are mostly advisable for or recommended for periods such as 3 to 5 years. There are sometimes bonds that are issued for 10 years, but you might want not to fix your money or lock yourself in such a bond that will give you a fixed interest, while you probably would have gotten more on the shares. But the good thing is also you can mix all these financial instruments in your portfolio. Property, or the real estate, the lover of many. Like property, it's either you own the physical property, you buy the property because you want to rent it out, or you want to buy the property, renovate it, and sell it at the higher value. That is type of investment that you can do. But also you can invest, as I've explained before, you can invest in property by putting the same money in what we call property funds, where you don't want to get your hands dirty. You don't want to deal with the headache of tenants. You don't want to deal with the headache of actual renovations. The property funds, or what we call real estate investment trust, those are the one that deals with the bigger property investment companies or developers. You will see a developer building new malls, building office space. That's the money coming from the investors who have invested their 500, their 1,000, their 10,000 into a property fund. And those billions are then taken to actually invest in the physical property. But at least you're not getting involved in management of those commercial blocks or those industrial infrastructure on those malls. What you will then get as a return is that dividends will be declared, because this mall will be renting out shops, and they will generate money and then put it back on the trust, and the trust will then declare to the investors that we are making profit. But remember, with property as well, it increases in value, just like in shares. So if such a mall was built 5 years ago, for example, a Gateway Mall was built 10 years ago, at that point, if it were to be sold to another property investment, maybe it would have been sold by 10 million. But the same Gateway today, if it was to be sold to another company, it's probably now worth more than 100 million. And that's because it has grown in value. It's either because of the surroundings that has happened around the place of Umhlanga, but the value of the property grows, and that also increases your investment as the investor. Again, tax, I think I forgot the tax component on the bond. The tax that you could incur on the bonds, because you're receiving interest gets taxed as part of your income tax. We obviously have a rebate or a threshold that SARS gave us per year, 23,800, where you can receive interest without being taxed if it's within the limits of 23,000 on all your interest investments. So you could have a bank account that generates 12,000, another one generates 3,000. In totality per year, only 23,800 can be received without being taxed on the interest. But if it's then more than that, it starts to be taxed according to your tax rate. Again, on your will, you need to write down who should receive your bonds so that they will cash it out and receive it as the funds. Property as well. With property, if you are buying property to sell it, you'll definitely then incur capital gains just like shares, because now the added value or the growth value that is in the property is called capital gain. That means the capital of your investment have gained some profit. SARS wants a share on that, but also on if you are having property and renting it out, SARS takes the rental as income, and income in South Africa should be taxed. You obviously can claim deductions against the maintenance of the property or against that income. So, but then the income should be taxed. All right. So I think I will answer all the questions. Zane, you are noting down all the questions, right?
Yes, I am. I will post them to you at the end of the session.
All right. So we'll have a Q&A session at the end. We are almost done. Then we've got cash as an asset, and then people usually ask, but how is cash an asset? Money is an asset, otherwise we wouldn't be needing it. Investing in cash means you invest in accounts such as your money market funds, your fixed deposits, your money market accounts that we fund. There are also interest-bearing accounts that are above just your normal banking account, and that's how you invest in cash. And when you're investing in cash, you're usually expecting an interest to receive an interest back. But again, as recommended in the beginning, cash is the lowest riskier asset, because when you've put your money in the bank, almost guaranteed that you will get it back. Obviously, if there are no penalties and any bank charges, you will get it as is. Although that is not a pure non-risk environment, because if you're getting your money as is, inflation is the risk in that case. So we cannot say it doesn't have risk. There is risk, but obviously the risk is lower than the other assets, but also with lower risk, that means lower returns as well. So cash is usually not advisable or recommended for longer term. Hence, I always say you cannot just stay with 100,000 or 200,000 in the bank account for like 12 or for like 24 months or even 3 years, because you are actually losing that value of that money. You are losing that money because the same 200,000 that we use today will not be buying the same amount of goods in the future. Again, with cash, if you're receiving interest, it will be part of your tax as your income tax. So it's included in the 23,800 that I've said. If you have cash in the bank, it's always, again, advisable to write in your will that any cash that I have in my bank account at the time of my death, it should be used for 1, 2, and 3, so that it will be clear and understandable by the family and the executor of your will of what then should happen. All right. So we always hear people asking, which investments should I go for? Which one is the best? The answer to that question is there is no best investment. The best way to invest is to make sure that you do not, we've all heard of the saying that you do not put your eggs in one basket. Because if a dog come and just push this one basket, all your eggs are then destroyed. So in investment terms, we call that diversifying. Always have your eggs at least in different baskets, so that if one basket is struggling, at least another basket is able to pull up your whole portfolio. So diversifying also increase your chances of of making profits or growing your investments. You've got higher chances of growing your investment if you've got a diversified portfolio than to put in just one in a basket, because if you've just put on one type of assets and then if shares are really struggling for the next 5 years, we've had that period where for like 3 to 5 years shares were just not having it. So they were just giving us negative returns. 90% of the shares, because the whole industry or the whole of South Africa or the economy was just struggling. So most companies were struggling, hence their shares were struggling. So if you've just invested in shares, you would have been bleeding during those times. But if you've diversified your portfolio in such a way that you've got shares, you've got a bit of cash, you've got a bit of bonds, you've got a bit of property, then it becomes easier when property is doing well to pick up the portfolio, and you end up having at least some positivity in your portfolio. So to find diversity and to also do not worry about pick and choosing the shares, because there's millions of shares that we can find in the industry. Within South Africa alone, there's so many companies, or if you get into the JSE, you'll be confused as hell of which share to choose. So the simplest way that probably could be used and that afford an opportunity in an easy and affordable way is through unit trust funds. That allows us the access to the financial markets that like the JSE. The good and the nice thing about unit trust funds is that professionals who have spent times into investigating these companies, checking their reliability, checking them if they've got potential for growth, have done the job for us, and they sort of mixed the caliber of shares that have potential for growth. They obviously can never be 100% correct, but at least they have made some research rather than you and me who's just going to say, okay, I think ShopRite is the best because they sell food, you know. They don't do speculations, but they invest in the research. So they do this combination of selecting all these assets. It's either money market, shares, property, and they put them together. So when they pull the money together, these shares together, they make a nice unit trust fund. We currently have more than 1,400 unit trust funds, which have been mixed with different purposes and different terms. So I always call them a pot of curry. It's either you like chicken, there are pots where there's mutton, there are pots where there's chicken and beef inside the same pot, and you just have a choice where you say, I just like chicken. So that means I just like a unit trust that will focus probably on resources. But some will say, I like a unit trust that will focus on resources, but telecommunication as well, a bit of that and a bit of that. So unit trust funds afford us with that opportunity to pull our little money, hence I said it affordable, because some unit trust funds even allow us a minimum of 250 per month to invest. So what could be the excuse not to start investing where you can actually access shares, property with only 250 per month? That how easy it can be and how affordable it can be. Then they pull all these monies from all of us who are interested in this, and then collectively they then go and invest in these shares and property shares that they have indicated on that share portfolio. So diversification means they will spread across these assets, but another good thing, they can further then spread according to countries and places. You find unit trust funds that allows you, while you're sitting here in South Africa, to invest in the US, to invest in the European countries and European companies. So while you are in South Africa, do not know anything about Amazon, do not know anything about Apple, the unit trust fund would afford you an opportunity to invest in those countries without you go physically there or buying those shares individually. Okay. So as I have explained, that because it's a mixture within the unit trust, there's a mixture of shares, property, cash. All these assets generates different types of growth. So within a unit trust investment, you find that your investment is growing in 3 ways. The first way is that you buy units, which are units represent the portion that you own in these shares. The unit grows in value. So if units are worth R2, over the time, the price or the value of these units grow, just like in shares. So the capital gain in that, when you then sell those units or cash out your investment, they need to sell your units so that they can give you the money. And then the gain from, which is the difference from what you bought with and what you are selling at, will then be the net value, which then determine how much you have gained. And that's how your money at first grows. But the second part is that the shares in your unit trust fund will be declaring dividends. So you get those dividends being declared in your unit trust investment, and then it will be reinvested. Sometimes you have other companies do give you an opportunity that when dividends are declared, they can be paid direct to your bank accounts. But for long-term growth, it's always recommended that get them reinvested so that you get the benefit of the compound interest. And then the third way is that because part of the combination of the unit trust is cash, you're definitely going to be receiving interest. So your money is growing in 3 ways. Hence, I said unit trust funds give you an opportunity to actually get positive returns. They might not be a lot if things are really not going well in the market, but at least it's a safe net that there will be some positivity towards the investment. Okay. Then we've got what we call ETFs. They're similar to unit trust, but ETFs track the basket of certain shares. Okay. Excuse me. So ETFs are a basket of shares, bonds, or other security, but they usually track the index, and they are sold as a one investment. When we talk of an index, we're talking if the ETF is following the industrial index. Industrial index means it only track the companies that are in the industrial space, the mining companies only. So it tracks only the growth on that space. If the ETF is only tracking the retail space, so it's only tracking the likes of your Pick n Pay, your shop, so all the companies that are in the retail space. But also you find ETFs that also track the combination of. The difference between ETFs and unit trust is that ETFs are low of cost. So they're very cheaper because they usually do not have managing agents or management companies, while unit trusts are made by management companies. So there's that little a bit cost on the unit trust, but also on the exchange traded funds, you need to understand what you are choosing because you actively manage the funds yourself. You need to choose what type of ETFs you want. You also need to track how they've been performing. So you actively manage the investment, while the unit trusts are managed by the professionals, as I've said, that have actually invested in the research of what goes in, what goes out, what's supposed to be good and what's supposed to not to be good. All right. But just like unit trust, they pull your money together with that other investors, and then they invest in the same set of security in the market. Investing for retirement. obviously, I don't know if this has been stressed enough in our society, how important it is to invest for retirement. And when we talk of retirement, most people think about the certain age to say, oh, I'll be 65, I'll be old, I'll probably not enjoy my money. Yes, if you work a 9-to-5 job, yes, that will be the time. But I always say with retirement, you also need to think about the time where you can work because you love to work, but you are not forced financially by the financial circumstances that you can't sit down because there is no money. Hence, it's always advisable or recommended that you save from your first check. And it's encouraged that you keep consistently save for retirement, because once you stop working, your life doesn't stop needing to be taken care of. You still need to maintain your lifestyle. You still need to, there's also added cost of health, because you would have been at a certain age where you need to see doctors more often. But also you need to enjoy your life. But if you do not save while you still have a consistent income, you end up then depending on the government grant. And that's not the picture we want to see. And the retirement savings rate is very low at the moment. We really need to up that. But I always say that we don't see the benefit of saving for retirement now, because it probably have not been communicated enough. One of the best savings for retirement that you get when you're using certain products, such as your retirement annuities that you can buy from financial institutions or your pension or your provident fund, is that when you save for retirement up to a certain limit, you get your tax reduced. And who doesn't want to pay less tax? We're already burdened by tax. And why not save for your future? Because you definitely need that money and you're going to be using it. And if you don't get to retirement, maybe you die, it's still going to be left to the people that you love, that you're creating wealth for anyway. While you actually save for retirement. So why not save for retirement and save on tax now, and killing two birds with one stone? So it is very important that you start as early as possible. Keep your investments consistent, add as in when you can. Get every opportunity to boost your retirement while you also save on tax, and use that savings on tax to actually do other things. So we always encourage that at least 15% of your salary should go to retirement. Remember that 20% of savings and investment, actually 15% of it should be going to retirement, because that's how important it is to save for retirement. So if you start late, it means you now have to up the percentage of your salary. So most of us who are formally employed belongs to pension or provident funds. But if you are self-employed, financial institutions have what we call retirement annuity as products that allows us an opportunity to invest in them. And those are the products that give us discipline, where we cannot touch the money until at least 55. Then at 55, you can access at least 1/3 as cash, and 2/3 is then used to provide you with an income to maintain your lifestyle. We're almost done. We know that while we try and look for opportunities and all the good returns that we are chasing, all the growth and investment that we're chasing, we face the risk of being scammed, because scammers are living amongst us, are people who know us, and they know sometimes we get to a desperate point where it's either you started late to save, so now you're looking for all the higher opportunities to grow your money quickly. One rule about wealth is that there is no quick way of making money. There is no quick way of getting rich. So it needs patience, needs time. So always look for the signs of scams. When somebody tells you that they will give you 30% within a month, just know that it's too good to be true. And if it's too good to be true, it's probably not good. So if you've been promised to get a lot of money in a short period of time, just run or ask a professional to vet that and tell you. If you always then need to motivate for other people to invest so that you can make return, that's probably a pyramid scheme. Or a scam of some sort. Investment do not need you to recruit. You can invest in your own 500. You can just talk about investing as motivating other people to take care of their future, but it really does not, your growth of your investment does not depend on how many people you've recruited. If you've got no knowledge of where your money is invested and there's no transparency, you're just being told, put your 20,000, you're gonna get your money at the end of the month. You don't even know what type of asset you're investing in. You need to run for your lives. If you can't trace the people that are motivating you to invest, there are no websites, they're not registered with the FSCA, which is previously known as the FSB. That's our regulator for every financial institution that provide financial products and financial advice that needs to be registered with the FSCA. And if those promoters of such investment are not registered, you cannot trace them, offices are dodgy, you need to run for your life. They usually will scam you, trying to make things professional, have fake websites. Be careful. If you cannot really point your finger, find someone to actually help you look out for such, because we see people losing their last pension money because they're trying to double it overnight. That's because they didn't save when they had time, and they're hoping that they can double. You cannot make millions overnight or in a short period of time. As I've explained over and over again, investment needs some time and as well as patience. Do not share your personal information with anyone that you are not trusting and you are not well aware what they do. All right, just touch a bit on insurance. This is a topic on its own, but I'm just gonna give some highlight what is important that we save and invest. But let's not forget that all can be in vain if you have not covered the important things, because remember, your biggest asset is not your car or your house. Your biggest asset is you and the power that you have to generate the income. So if the power, which is you, or the source of generating the income to buy the house, to buy the car, to invest, is no longer there or is not protected, that is when all just crumbles. So insurance is there to cover for all the dangerous events or the risky events that we face, but also our assets that we accumulating are facing to get destroyed. So we've got long-term and short-term insurance. Remember, insurance protects you and your assets from any risk, as I've said. So it's usually the events that we don't expect. It's events that we sometimes don't know when they will happen. Some events we're not even sure if they will ever happen in our life. One thing for sure that we know is we will die. That's the only risky event we know. That will 100% happen in our life. But the bad thing about it is that we don't know when it's going to happen. Hence, if you've got kids and family that you love and you're building all this wealth for, it's then recommended have some insurance that will cover you or your life if anything happened, God forbid, way earlier than you would have wanted to accumulate all this wealth. There is something to replace the value that you would have created in the lives of those who are left. While short-term insurance talk to protecting the things that you've accumulated. Nobody wants to work backwards, where I buy a car and then tomorrow, bam, an accident happens, and then I now need to pay for the car that is no longer there, while I still need to own another car. So things, life end up getting backwards. So protect such assets or possessions that you know that if there was something that has to happen in those things, your life will then be turned back, or it will hit your pocket. For example, your house, if there is fire, or your expensive cell phone, your laptop, if it were to be stolen, you'll need a big amount of cash to replace it. Why not then cover it? So that what insurance is important is because, yes, we can invest and save, but we do not have a third eye or a fourth eye where we can see, okay, I'm going to be disabled, I'm going to be diagnosed with cancer. What will then happen? Now you can't work. What will happen? So you need to ensure that if the doctor could say, well, you can't work for the next 6 months because you've got TB, at least your income is protected. You've got income protection, and it's replaced. Okay, obviously there are a lot of types of insurance products that we have in the industry. I'm just checking time. We're almost done. We've got funeral policy, which ensure that you don't incur extra expenses if those around you die. You're able to give them dignified send off. Life policy, I've explained, pays out in the event that you die, so that your remaining family members can continue with the lifestyle that you would have hoped for them. You nominate beneficiaries. If you haven't nominated beneficiaries for insurance, it pays on your estate, and it can create complications. So it's always advisable that ensure that all your policies are updated, all your monthly payments are paid in time, so that it will stay intact. With life insurance, you need to ensure that you disclose any illnesses, because it's based on your life. And if there's any non-disclosure or dishonesty that has happened, the life insurer might not pay that cover because you have hidden something. All right, I think I've touched on the wills here and there, but everyone needs to have a will. If you do not have a will, please find an estate planner that will do a will for you, an attorney. For you to have a will, you just need to be 16 years of age. Even if you are married or single, if you have a life partner, you need to have a will. If you have dependents, you need to have a will. If you have extended family, you definitely need to have a will, so that they will not fight over your things. Obviously, if you've got a lot of policies and investment, you need to ensure that they are distributed according to your wishes, because if you don't, they're going to be distributed according to the wishes of the master's court. So to ensure that you die in peace and there is no noise after your death, people just pulling through here and here, I own this, I will take this, just have a will and ensure that it is signed by 2 witnesses who are not beneficiaries on the will, so that it be a valid will. If it's not signed and not signed by 2 witnesses, it doesn't become a valid will, even if it's written with all the English. So for it to be a valid will, it has to be signed by you and 2 witnesses who are not the beneficiaries on the will. Okay, so you obviously list everything that you have in the will. If you've got kids that are under 18, you need to say who will be their guardian. You need to also nominate the person who will manage the estate, ensure that your estate is distributed accordingly. That person, we call it an executor. Full names and ID of the people that will inherit needs to be there on the wills. Title deeds of all properties needs to be included. So you always need to have somebody who understands the laws, that they include every important information on your will. All right. Okay, as I've mentioned, your will needs to be signed in front of 2 witnesses. The witness needs to be 14 years and older. People who are beneficiaries cannot sign the will. You can seek help from people like myself who are financial planners, or your bank or a lawyer in drafting the will. You always need to update your will at least once a year, or every event that changes in your life. So a birth of a child, a marriage, divorce, if you buy property or any assets, that is a requirement for you to change your will. All right, that's it for me, and thank you for giving me your ear. I am so excited. I think I tried to keep it on time. Thank you so much. Zain, I am taking it back to you for the questions.
Thank you so much, Tembisa, for that wonderful insight into the various savings and investment options. I know I most certainly learned so much more than I knew when I first arrived on this webinar this evening. So what I'd like to do right now is I'd like to take a few questions. Tembisa, there was a question that was raised by Sibongile Zigali. She'd like to know, how and where does one buy bonds? Can you possibly respond to that, please?
Okay, if you want to buy individual bonds, you can find them on the government retail bonds website. I think the last time I checked, you could also find them at the post office. But you could also access bonds through unit trust. So if you find a financial planner, they will give you an access to unit trust that includes bonds as part of the asset combination of those unit trusts. But there are those people who prefer to buy bonds just as an investment on its own, without mixing it with anything else. You can find on the government websites. It's called South African Government Retail Bonds. You're able to find information there. Yeah, I'm not too sure if the post office still offer them, but before they used to. But another way will then to access them through the unit trust.
Okay, thank you very much for that. Sibongile, I trust that we've answered your question there. Then there was a second one from Ustandiwe Duze. Ustandiwe would like you to please explain more on capital gains tax on shares. And she'd also like to know is what happens when there is a loss on equity.
Okay, capital gains is when I buy a share today with R1, right? I invest for 5 years. The share grows to R5. At year 5, I decide to sell the share because probably I need the money or I found another investment opportunity. So that means there would have been a R4 gain, capital gain in my share investment. Now, how SARS want a portion of that? They say, on the gain that you've made, we want a percent, we only tax a percentage. At the current rate, SARS say we give us an annual exclusion amount of 40,000. So everyone have 40,000 exclusion of capital gains. So all your investment can grow or have a capital gain up to 40,000 without being taxed. But once it's over 40,000, whatever is above 40,000, 40% of that will then be taxed according to your tax income rate. So what it means is, for example, if I make in a year a gain of 100,000, that's because I made an investment a few years ago, and then this year I cash out my investment. That means I sell my share. I make a gain of 100,000. 40,000 of my 100,000 will not be taxed because it's part of the exclusion. Then 60,000. On the 60,000, only 40% of 60,000 is taxed according to my income tax rate or tax bracket. So 40% of 60,000 is about, let's say 25%. I'm not quite on the right tracks. So 25,000 will then be taxed. If my tax bracket is 31%, 25,000 will end up being then off the total 100,000. Then 25,000 will end up being taxed at 31%, which is my tax bracket. That's how capital gain tax works.
Thank you very much for that. Sandiwe, I hope and trust that we've answered your question adequately there. If you can just give me an indication via the chat. I'd also like to ask if there are any other questions. If there are any other, please raise your hand and I would allow you the opportunity to go ahead and ask your question.
Okay, I think on Sandiwe's question, the last part was that what happens when there is a loss? Losses are not taxed. So there's like what we call a rollover. You can also not claim a loss as a tax deduction. It can't happen. It's just doesn't, there's zero tax that will be attached to your name.
Thank you very much for that, Sandiwe. I think we've answered that for you now. Is there anyone else that has any other questions? Anyone at all? I see there's a question coming through on a Q&A. Dedisile, you may go ahead and ask your question.
Unmute yourself.
I have.
Thank you, Dedisile. We can hear you. You can go ahead and ask your question.
Thank you very much. Since we are women in business, and I remember last week we learned a lot about us not using our business cards to do our personal stuff, like using the business card to swipe to Woolies for your personal things. Now, at some stage, if you have a good accountant, those transactions will be taken as members' loans. And if the members' loan keep on increasing and increasing, what are the implications in terms of SARS? I know that everywhere where you are talking about savings, SARS keeps on popping in, and he always or she always like to spend our monies. Now, if we keep on lending money from our businesses to our personal accounts, what are the tax implications if you are unable to pay back the loan to your business, as you are a business owner, but you keep on drawing from your business as a member's loan? Thank you.
Okay. It's more of a technical question, but I'll try and answer it. With loans and you as a member of, or you as a business owner owning from the company, if I'm getting your question correct, doesn't have any tax implication on your income tax. If that's the question, the answer is you cannot claim the loan on your income tax affairs personally on your tax affairs. On the business side, the business still need to show that there are loans in care interest. Otherwise, the last time I remember, I think there's a penalty if they just give zero interest to their members. So on the books, this needs to be verified again with an accountant. But I think on the book, they needs to show that the member are paying. If they're not paying in the long term, in accounting, we've got what we call bad debt. So that loan might be written off through a bad debt transaction if you end up not failing. But that also compromising your business at the end of the day. So I will then not recommend it. What I will then recommend is, if you're a business owner, rather structure your business in such a way that you earn a salary from it. It's either you structure that salary in such a way that obviously you don't want to put yourself in a high tax bracket, but do earn some sort of a salary instead of just eating profits.
Thank you, Thembisi. Tembisa. Delisile, are you happy with that?
Thank you. Yes, I am. Thank you.
Thank you very much. So, ladies, I know that I most certainly learned so much more than I did when I first started off. Now, just to recap, I think, to walk away, what we should be walking away with from this webinar is firstly, is that savings is important in creating wealth. It's important that we save for short, medium, as well as our long-term goals. And ultimately, Tembisa also indicated, as did I last week, that it's very, very important that we that we start saving for emergencies. I know we often hear this, people say, it's not easy to save. And yes, it does take discipline and determination. And ultimately, we think we need to start considering saving regularly. And I think Tembisa also mentioned earlier on, when saving towards a goal, ask yourself this question of what, when, and how. And, set yourself a realistic goal. Don't choose an amount, or choose an amount that is affordable to you, and a realistic goal that you can actually achieve with an amount that is affordable. And, the other thing is to explore and find suitable savings and investment products. I mean, Tembisa's gone through a good few for us, and I know I most certainly am going to be choosing one or two of them. And the important thing to know is that the longer you save and invest, the better the return. So when choosing your saving options, go for long-term as opposed to short-term savings. And, I think I mentioned this last week as well, is to consider a forced or contract saving option by means of stop order or a debit order. And ultimately, ladies, I think we need to be aware of these quick rich schemes. And of course, more importantly, if you need more information or you need consultancy, then consult with a financial planner. And I know that a lot of that information can be found on our websites and our guidance on the website, where you get a lot more information on financial planners and how to find them and where to go about finding them. And I know that we spoke about, accessing the website as well as the Facebook page. The Facebook page, I think it was mentioned last week that it is a closed user group. I'm going to ask Crystal to just broadcast that on the chat again, so that everyone knows, for those that were not in attendance last week, that we have a website as well as a Facebook page. The Facebook page obviously is a closed user group, and it has a whole lot of information on everything that we would be discussing throughout the series of webinars. So, ladies, I would also like to take this opportunity and thank every single one of you for being here and for participating. It's been a great session. Tembisa, to you, thank you very much. It's been extremely insightful, and as I said, I've got so much more knowledge and information than I had, and I know that everyone else does as well. And I look forward to seeing everyone else again on Tuesday next week.